Hi, investors. It's Nick.
Hi, it's Martin.
And we thought we'd do a little fireside chat with you, just talking about what we're seeing, and we thought we'd relay it to you, really. Obviously, we live by, or, our thing is to understand the market. And we are up close to the buy-to-let market in the north of England. And there's some very interesting kind of macro trends going on. And I thought it would be helpful to do a short video just talking through what we're seeing, how we feel about it, what seems to be working, what's not working. Martin, do you want to just share your general opinions about what's happening?
The market is still going hot. It's still hard to book a viewing. And as we have in the past, like from 10 properties, we'll book a viewing for 6. From 6, we will send an offer for 5, and only 1 will be accepted. So that's how it's going. So, but also it depends how lucky you are, because we have situation when somebody will send 10 offers and it will have 0 acceptance, and somebody will send 3 offers and 1 will be accepted, or 2. So
a lot of that's about how strong they are as a buyer, I guess.
Yeah, and how strong you are, what kind of properties, if it's in hot area, it's and perfect condition. A lot of owner occupiers will want to live there. So depends. So in my point of view, we need to avoid this, like, not to avoid, but you need to prepare to bid high. For example, if you want to buy in Stockport, or you want to buy Swinton or Salford in Manchester, and the asking price is 220, you need to know that the property will sell 240, maybe 250. Depends on the condition. If it's perfect condition, it will bid a lot. We have one property, asking price was 180, it sold for 220. So that's what's in Swinton.
I think so. What I'm seeing is just on a very high level, and then kind of working down. There's an overall citywide pattern, which I'll just show you by sharing screen. And this is a consistent theme. So here's Manchester, but we'll have a quick look at other cities. City centres are not doing great. So green is bad, red is good, roughly speaking. This is for capital growth. And if it's got a dark blue centre, that means there's a lot of rental demand. If it's got white, we don't have the data. And if it's kind of light blue, there's less rental demand. But generally speaking, there's huge rental demand. And what you'll see is that outer areas are hotter than inner areas. And this would be city centre stuff. That's doing badly. This ring here for Manchester, so within 20 minutes drive of city centre, this is very hot. And then these outer areas are kind of heating up. But you have little towns and spots that are doing well as well. And then if you look at Liverpool, roughly the same pattern, the city centre apartments not doing great. And then this outer ring doing great. And this outer ring warming up. And I'll show you one more city just to give you context. Let's have a look at a big city like London. Now, London is sort of unique, really, in that city centre, East London apartments and all that, the equivalent of Manchester City, so all these lifestyle apartments and so on, not doing great. And then you have these outer areas around the M25 doing much better. Same kind of pattern. And I'll just do one more, which will be Sheffield, because we were looking at Sheffield earlier. And same story, city centre, not great, outer doing better. Now, what's going on overall is that the property market is entering into the middle of the kind of first third of the boom phase, I would say. So I think we've got 2 years left, much like last time. And the smart thing is to buy in those areas which are crash resistant so that you are doing okay. Now, I'm not going to get into all of the wheres and wherefores. I'll do a separate video on this, just doing a deep dive explainer into this. But the short of it is that the cycle that I'm seeing, if we go back to Manchester, the cycle I'm seeing is that certain areas are just getting ridiculously overbought, and therefore they're displacing. The danger is that you end up, or investors end up buying in areas that are compromised, and then they're going to get absolutely screwed in the crash. So the number one rule is to avoid compromising yourself on areas. And the other thing I'm seeing increasingly is a lot of investors piling into the market, not only in Manchester, but just Sheffield, just everywhere really, that's decent for investing in. So this is also parts of Liverpool. But the very worst areas like Blackpool, Hull, Newcastle, yeah, those kind of.
Bradford is also bad.
Where?
Bradford.
Bradford, yeah. Well, Bradford's actually declining in value at the moment, which is a weird anomaly. But there are reasons for that. Cultural divide reasons, which is very sad, but it's just a harsh situation out there. Anyway, the bottom line is that it seems to me that the best strategy overall is to avoid the ridiculously hot areas like Swindon, Stockport, Salford, these kind of places which are being piled into by investors. So there's a broad story, which is certainly in Manchester, and I think increasingly in other cities, it's becoming investor-led. So, for example, in the United States, the market is investor-led. The owner-occupiers don't have the cash anymore to compete, and it's the investors piling in. A lot of Hong Kong Chinese, but also a lot of UK people, because they know that inflation is going to kill their wealth. Because imagine if you have 8% inflation for 5 years, that's 5 8s 30, 5 8s 40, yeah, 40%. I've got £100,000 today. My money in 5 years' time is worth £60,000. It just makes sense to get your money out of cash into property. And I think now we're into the last phase of the cycle where it's very investor-led and it's starting to lose its mind. But they have to invest because otherwise they lose wealth through inflation. So then you're into the whole thing about, okay, well, if they're all piling into Stockport, Swinton, etc., and it's getting bubbly, in other words, a bubble is building, then my advice is stay away because you're going to get screwed. Now, I wouldn't have said that a year ago, but I just feel there's less and less actual value in these really hotspot areas. And I'm going to ask for your opinion, Martin, because you are close up to what's going on. But I'm just going to give you my kind of high level. And therefore, I think the answer is to look at areas which are fundamentally good, nice communities, good demographics, low crime, nice location, but a bit further out that would be rented by people who are economically robust in a downturn. And if you refuse to accept certain compromises, like you avoid that house which is beside the motorway, that kind of stuff, you avoid where there's a lot of crime, then I think you'll be okay. You will see less capital gain, but actually you will see less capital decline in the forthcoming crash when it comes. And it will come, because there have been 9 property cycles since 1845. There is such a thing as a property cycle. Martin, what's your take?
I think if you don't want to overpay a property, just like stay away from the hot areas. But if you want to compete, yeah, you still have a chance to take a property, but you need to be ready that you need to pay a lot. And my advice is,
yeah, and the risk is you will suffer big capital declines in a crash.
Yeah, And my suggestion is like, don't search for the perfect condition properties. Find a property who have at least a little bit renovation, just because the perfect condition properties are usually overpaid, because owner occupiers can pay a lot more than an investor because they have lower interest rates and so on. So yeah, so my suggestion: find a property need at least painting and decorating, at least, so you will have less competition, even if it's in this best area. So yeah, and don't try to find like a property who have a structural issue on a lot of renovation. Just
Yeah, they're dangerous.
Yeah, they're dangerous, and the renovation will be hassle. We are here to help, but it will be hassle, and it will take months to be completed. So and maybe they'll have risk with mortgage. So my suggestion is like renovation from let's say from 3,000 up to 25,000 is the best for investing. Depends how much cash you want to spend. If you want to spend less cash for renovation, purchase a property who needs like minimal renovation, but at least need renovation. Yeah, that's my suggestion. And if you want to have spend more cash, yeah, find property who needs like new kitchen, new bathroom painting, decorating. So yeah, and you will have more chance to take it, and you don't need to overpay at the end. So depends. Also, location is really important. Like if it's real near central city, like Stockport, or it's in the place like Dresden, or it's Swinton or Salford, Eccles. That's really close to city center of Manchester, but good areas. If the property is 180 for 2 bedrooms terrace house, you need to prepare to be ready to pay at least 200.
Yeah, and the same principle applies to your video is dropped. The same principle applies to any city, actually. So we've got this tech. We can see what every local market in England is doing, and it's very easy for us to work it all out. And the same, again, the rules are the same. It's all about demographics and all of that stuff. But what I would say is increasingly, I'm seeing properties that need a lot of renovation, those in these really hotspot areas, being bought out at very high prices by investors. And what they probably don't realize is that good contractors are really hard to find. And we know, because we hear all the war stories of people getting absolutely screwed by contractors. But they probably don't realize that, most of them. And they're just like trying to dump cash and try and find value, find something that they can renovate and then refinance and so on. So it's an interesting state of the nation. For me, so I'm going through, so I'm actively seeking now, and I'm inclined to avoid these ridiculous hotspots because I just think they're too overcooked. And I am looking for stuff that's fundamentally sound around Greater Manchester. So in other words, where there's maybe a 40-minute public transport journey into central Manchester, decent demographics, that kind of thing, that's good.
15 minutes, I'm not sure that is
40.
Yeah, 40.
40. Yeah. 40 minutes, that kind of thing. So those kind of areas would be Radcliffe, I suppose, wouldn't they? And
yeah, Middleton, Little Houghton, maybe even like Moston is not that, but not all Moston, but some places in Moston are good for investing. Yeah, so you have a lot of Denton is not bad. Well, Ashton-under-Lyne, some part is good for investing. Ashton-under-Lyne is also not the best because of the yield, but you have some areas where the yield is okay.
And the same applies to Doncaster. It's a town that we both really like, and there's some very nice housing stock there. The issue with Doncaster is because it's small, there isn't that much property coming up. But the good stuff is good. But there is a general rule here, which is finding nice houses for nice middle-class people to rent. because they're the ones who survive in a crash, and they pay their rent, and they're less likely to be disruptive because they care about their credit history and their reputation. Whereas if you go the other end of the spectrum and you go for the very high yielding properties, which are cheap, 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 like under £100,000, just expect trouble, because there will be, inevitably, because the kind of people that live there are just, they're just hoping for the best, which is sad, but this is the brutal reality of it all.
Yeah.
Any final words from you, Martin?
If you have questions, please let us know. We are here to answer. So if you have some specific areas or you want to know what's happening in some areas, we can give you more info. We have calls with agents. We have calls. We have also letting agency. We follow the rental market every day, so we know how much is increasing. So everywhere the rental market is increasing right now. Sheffield was lower in the rents, but these days I see that Sheffield also start to increase the rent, so which is great. So now also Sheffield is a good place to invest.
I think, do you know,
like 3 months ago, Sheffield was the markets, rental markets was not increasing, but now it's increasing. So Sheffield is also a good place to invest, but not everywhere. But some part of Sheffield is increasing in the rental market, which is great. So yeah, the market is getting hot and hot. So
yeah, I think a lot of this is, sorry, I know we just, sorry, this is why one does these structured things, but it's not structured. But just to say, a couple of things I would always watch out for. One is, when you look at a city, it's important to look at the gross domestic product and the overall economic viability of the city. If rents are going up, but the economy isn't strengthening, then there's a problem. And Sheffield's economy is okay. It's not great. Manchester is this great big machine that's working very well. Birmingham is okay, but it's very sprawled and decentralized, and so on it goes. Now, Martin and I are going to be doing a big series of city assessments where we look at all these things. We're going to follow a structure which I'm yet to finalize, but the idea is we're going to talk about these. We'll talk about the macroeconomic stuff, the capital growth, and then Martin's going to find properties of interest. We'll analyze these and just going to give you a sense of what's going on in each city. But the thing that I think is going on now is that the people who want to buy a property have either bought the property or they're kind of giving up, and then they're going, well, it's too expensive now. I may as well use this cash I've got and just pay a little extra for rent and buy something nice. And therefore that cash nest egg, those cash nest eggs, I think might well be kind of getting absorbed, as it were, into extra rental cost. And in this segment, the under £250,000 segment, it's increasingly dominated by the investor. And that's not really sustainable. And this is where we are now on the countdown to the crash, because a market has to be sustainable, and it's not. So it's just a question of when. And that's why, I know it sounds very negative and all that kind of stuff, but you got a choice. If you're an investor, what do? You sit there and let inflation kill your wealth, or you just get your money out of cash and into property. And in my view, the good days are over, and which were from 2018 to, say, the end of COVID, 2020, early 21, that kind of thing. And then we've had this gradual slide into the heat, as it were. And certainly for my part, I know that I've got to get on with it and buy a load of property for my family, and I get on with it. There's no choice, really, because inflation will kill my wealth if I don't. And that's why I just counsel you as an investor, just hang on to the fundamentals, look carefully at the kind of people who rent, and be aware of condition and all the usual stuff. So there it is. It's not a very positive situation, weirdly. It's like one stick is bigger than another. So you got one stick, which is like properties getting unaffordable, and the other stick, which is you lose your wealth if you're not careful to inflation. So which stick would you rather get beaten with? Well, I'd rather take the property being a bit expensive, actually. So that's kind of where I'm at with it, just on a personal level, and I think other investors feel the same. Okay, over to you for the last word. Any sage advice from you, Martin?
Happy shopping, happy investing. Yeah.
Yeah, indeed. All right then. Thank you very.
Thank you.
Thank you.